Hey friends, Andy here. How you doing? Good to see you. Someone told me I should pay my taxes with a smile, but when I tried that, the IRS demanded I pay with cash. Dad jokes. I wonder what would have happened if I tried to pay in cryptocurrency. On that note, today we're going to have a quick look at the tax implications of cryptocurrency. Whether you're buying it, trading it, mining it, or getting paid in it, sooner or later you're gonna have to pay taxes on it. Harsh, sad reality. The question is, how much do you have to pay? And are there ways to reduce your tax burden? Well, I guess that's two questions, but let's answer them both. Let me start with a short spoiler alert. You should pay your taxes. Second spoiler alert, cryptocurrency follows most of the same rules as other types of income, and taxes on it can be sheltered and reduced in pretty much the same ways. If you buy it, it's treated like stocks. If you earn it, it's treated like income. If you'd like to learn more, stick around while we have a look at some of the nuances of cryptocurrency and talk about how you can make sure you don't pay more taxes than you need to. If you get some useful information out of this video, and if it's not too taxing, I'd appreciate it if you pay the YouTube algorithm tax and click that like button. It feels great, it's free, and it helps my video out a ton. Thank you. Thanks. Paying taxes. Having fun. First off, just in case it isn't completely obvious, I am not an accountant, financial advisor, lawyer, tax robot, or someone who is in any way qualified to give you financial advice, especially when it comes to things like taxes where not paying them could land you in a whole heap of trouble. I'm just some guy with a YouTube channel, and pretty much anyone can get one of those these days. So please consider this video general, well-intentioned information that may or may not be relevant to your particular situation. If you've earned, mined, traded, or been paid in cryptocurrency, it's never a bad idea to consult your own tax professional. Way back in the dark ages of 2009, cryptocurrency was shady and mysterious, and it was relatively easy to hide your crypto earnings. Not a lot of people knew about cryptocurrency or understood it, and there weren't a whole lot of mechanisms set up for the government to keep track of it. That's changing quickly. These days, the IRS asks you straight up on your tax return if you've received, sold, sent, exchanged, or otherwise acquired any financial interest in any virtual currency. Top pro tip, don't lie. As crypto becomes more mainstream, the IRS is making a big effort to let people know that crypto is just like any other asset. Crypto trades need to be itemized on your tax returns, and taxes need to be paid. And in order to make sure that the message gets through loud and clear, the IRS is cracking down hard on people who are trying to avoid paying their fair share. So, do you pay taxes on cryptocurrency? Short answer, yes. The long answer is yes, and it depends on how you got that cryptocurrency. The simple version is if you mined it or were paid in it, it's treated like income and is subject to the same state and federal income taxes that you'd pay on fiat money that you earned. One note about mining operations: while the crypto you mine is taxed as income, you can deduct your own mining expenses if you own a registered business. On the other hand, if you buy, sell, or trade cryptocurrency, it's treated more like stocks or other property. Just like stocks, if you buy cryptocurrency and then sell it at a profit, you'll pay short-term capital gains taxes if you've held it for less than a year, and long-term capital gains if you've held it for 12 months or more. If you sell at a loss, you may be able to claim long or short-term. If you sell at a loss, you may be able to claim long or short-term capital losses as well. And if you're lending your crypto, then you'll get taxed on the interest you make, just like you'd get taxed on interest you make on a savings account. And just to be clear, it doesn't matter if you leave the money in your crypto account after you've sold it for dollars, or if you withdraw it and send it back to your regular account. Once you've sold it, you're subject to taxes. Now, what happens if you use cryptocurrency to buy goods or services? Is it taxable then? This is where it gets a little complicated. Find my eye. Okay, before we go any further, let's define a few terms that you'll want to know next tax season. Number one, cost basis, which is the original value in fiat cash, i.e. dollars, that your crypto cost when you bought it or were paid in it. Number two, taxable event. A taxable event is any action you take with your crypto that results in a tax liability. Buying crypto is not a taxable event. You can buy as much as you want. Taxes don't come into play until you get rid of it. However, selling your crypto for fiat cash, using crypto to buy goods or services, and trading one kind of crypto for another are all taxable events. And every taxable event needs to be reported to the IRS with the cost basis, the sale price, and dates of purchase and sale or trade. Every single one. If your cost basis is lower than the amount the cryptocurrency is worth when you have a taxable event, then the cryptocurrency has gained value, and you've got a tax liability. If it's worth less, then you have a tax loss. If you've done a lot of trading or maybe used a robo-advisor to make your trades for you, and you're wondering how on earth you're going to figure all that out, don't panic. There are companies that allow you to import your crypto trading history from whatever exchanges you use, and once you've done that, it just spits out a complete tax report for you to hand straight to your accountant or the IRS. In theory, if you've used a US-based crypto exchange like Coinbase or Binance, in theory, your exchange should send a 1099 form to the IRS to let them know how much you earned with any crypto trading you did. But even if they don't, that doesn't mean you're off the hook. If a company is in compliance with United States regulations, the IRS has the power to get your records, and you are still liable for any taxes you incur whether or not your exchange reports to the IRS. Now, if you used a foreign exchange, the IRS really can't access your records or see how much you've made. However, it's very difficult to withdraw that money to a US bank account without leaving a paper trail of some kind. If you get audited and the IRS notices a large sum of money deposited into your account from an overseas source, they're going to start asking some awkward questions. So we know Uncle Sam is going to take a cut. The question becomes, how can we make sure he gets as little as legally possible? To begin with, buy and hold long term. Sure, there are times when it may or may not make sense to do that, but if you can, try and hold on to any crypto you buy or trade for at least 12 months. The reason is that short-term capital gains are taxed up to 37% depending on your income, but long-term capital gains are generally taxed at a much lower rate, usually 0, 15 to 20%. So one of the simplest things you can do to avoid or at least mitigate your taxes is to do nothing or at least as little as possible. Buy it, hold it, never let it go.
Once you have found her, never let her go.
Another option is to open a self-directed IRA. This is a type of traditional or Roth IRA with the same contribution limits, early withdrawal penalties, and tax advantages, but where most regular IRAs just let you invest in stocks, bonds, and funds, you can put all kinds of crazy things into a self-directed IRA. Precious metals, real estate, and commodities, for example. And cryptocurrency, because why not? There isn't enough time in this video to go down the rabbit hole of self-directed IRAs. Just be sure to familiarize yourself with the regulations around them. The biggest drawback, of course, is that these are retirement vehicles, so you can't take your gains out until you're 59 and a half without paying a penalty. But if you're in it for the long haul, this could be a great way to shelter your crypto. Where you live can make a difference. The federal government is always going to take its share, but you could significantly reduce your overall tax liability by living in the right place. Currently, 9 states and Puerto Rico don't tax capital gains. Now, there are tax trade-offs in every state, and you may just not feel like packing up and moving to Wyoming. No judgment, but if you're a real wheeler dealer and capital gains are a big part of your income, it might be something to look into. And finally, if you have losses over the year on crypto or anything else, keep track of those and report them on your taxes. They can be used to offset taxes on gains for this year or even in the future. To wrap all of this up, cryptocurrency isn't a whole lot different than any other type of asset. If it's worth more when you get rid of it, then when you got it, you have to pay taxes. Same if it's given to you or if you inherit it. You'll be taxed on it just the way you would be if it were cold, hard fiat cash. Don't assume that crypto is somehow special or exempt in any way, but do be aware of the ways you can keep your tax burden to a minimum, and then you can pay your taxes with a smile. If you found this information helpful, please like the video and subscribe for more money-related content on my channel. And while you're at it, follow me on Twitter. I post original content there every single day. And if you have any clever and legal ways to avoid paying taxes on your cryptocurrency trades, please share them down in the comments. Otherwise, I will see you in the next video. Goodbye.